So, a rare upward close on a Monday. We've had this sell-off Friday through Monday thing going for the last month or so. Today, a reversal of that. Nice up move with the markets up, 3 to 4% depending on the group you're looking at. So, a nice rally to start the week. Today, we like to look at the markets on a Monday from the macro perspective, the top down, by sector, by individual stock, see what sort of themes we can tease out, how it can help us paint the overall picture. Ladies and gentlemen, this is the final bar. Hey everyone, Dave Keller here with StockCharts.com. I'm the Chief Market Strategist here in Redmond, Washington, here to help you navigate through this bear market environment, or I guess with the last couple days, what we might call the mini bull within a larger bear. I was on the Chart Summit conference over the weekend that JC Peretz at All Star Charts put on. Was very happy to be a part of it and shared my 7 tips for navigating the bear market, my bear market playbook. And as we were going through it, there are so many guideposts about this moment that we are in a what feels like an unstoppable short-term rally, but still within overall what is very much a bear market phase. And I think it's super confusing or super distracting, some of the percentage moves that you see day to day. So today, if you look at the last couple of days, look at the market dashboard, you see 2 days that are going up. Even with Friday sell-off into the close, overall the trend has been positive. Everything's in the green. Life feels pretty good, but we're going to try to sort of make sense of where we're at, put this into proper context, looking at sectors and individual stocks with you. In terms of upcoming events for the show, we have some great guests joining us this week. Tomorrow I have Mark Newton from Newton Advisors. We have Ari Wald from Oppenheimer, JC O'Hara on Thursday, and then next week we have Harry Boxer on April 7th. Wednesday on April 1st, I do want to point out we have a special event called The Pitch. We asked some of my fellow StockCharts contributors, Grayson Rose from the StockCharts team, Tom Boley from Earnings Beats, Mary Ellen McGonigal from the Mem Edge, to share with us some of their stock ideas. Where are they looking for opportunities within this current market environment? You're not going to want to miss this as they put together sort of their model portfolios based on the themes that they are seeing. So have them give us their pitch. We'll have a nice discussion and leave you with some actionable ideas. So don't miss that coming up on April 1st. So trying to recap the markets here, folks. Again, I would caution you. The mood at the conference that I mentioned this weekend, the Chart Summit, it was sort of muted. I mean, the general thesis, if I could summarize it, was this is a challenging period. This is a bear market phase. Most of the speakers, including myself, you've been through other bear market phases and kind of have a sense of how they feel and how they look and what to look for. And for me, one of the things I kept hitting on was the severity in terms of price and time of bear market rallies. So these big up moves within a bear market trend are super difficult, only because it is so tempting to jump into these. And I would say one of the key things, if you think of my guests last week, Pat Saresna was actually showing a really good chart. The simple idea of what percentage moves mean. You look at Boeing, it's up 90% off the lows, but it's still way below where it was before all of this happened. So it's very easy, especially if you get too caught up in the short-term moves, to get too caught up in it. So, I would remind you again, let's keep a focus on what today is doing. Let's look at the movements today, but then let's think a little more longer term about stocks and sectors and where they're actually at within these phases. See what sort of conclusions we can draw. So the S&P today up 3 1/3%, up above 2626 to close the day today, which again is a rare up move. The last couple of weeks, we've actually gone down Friday close to Monday close. So there's a bit of a break in that pattern, showing potentially some short-term optimism here. Mid caps and then small caps lags, so we're back to that mega cap leadership that we've seen for quite a while. This up move today pushed the VIX down below 60 now. For the first time in a little while, it's down around 57. We're going to get to the sector themes in a little bit, but just in terms of today's trading, just to point out the top 3: healthcare, technology, consumer staples, I don't know what my friends are going to say for the pitch on this Wednesday in terms of ideas, but I wouldn't be surprised if they come from these three sectors: healthcare, tech, and consumer staples. So, again, it almost feels like the vote today is, buying, but it's buying into some of those names that, should do well in an extended period of struggle, which is certainly the feeling that I've felt. On the bottom, you have energy still up, but down, up the least, followed by industrials and then financials. And one of the ratios we're going to look at later is looking at tech versus financials, which has been actually a very interesting longer term illustration. We're going to talk a little bit more deeply about some of the stocks in here, but I did want to point out as we think about this environment, I think it's always a good time to be a stock picker, especially now. Remember, there are things that are fluctuating. There are things that are breaking to new highs and new lows. Not as many new highs right now as you may have had in previous cycles, but there are stocks moving. And I think when you're looking at a stock like State Street, when I'm thinking about today's recap, there are things that feel like they're pounding out a bit of a bottom. I think the question now is this a short-term bottoming pattern? Is this a quick rally before we have the next leg down, or does it have a little more staying power? And that's where I think you really want to go back to a technical checklist. Think of the steps that you would want to see, the checks that you would want to make on the list to feel comfortable owning a new position in something. And once it qualifies through those, I think you can draw some conclusions. So, again, from a macro level, and again, this is one stock. This is State Street, right within the asset managers group. So it's just one stock, but I find a lot of stocks have this sort of pattern, and the broader market does arguably as well. We've had this deep sell-off going to new lows. Then we've rallied up. We've now established a higher low. Arguably with State Street, we put in a higher high, and now a higher low, just looking at the most previous swing. And now today we're just closing above that previous high. So it certainly feels like there's a building of positive momentum. There's some accumulation going in there. This isn't a one-day move. This is now 6 to 8 trading sessions that we're sort of chipping away higher. So, if charts like this have staying power, if we continue to see some upside momentum on here, I think it's pretty interesting. What's funny though is when you look at the momentum picture, and that's what I want to show you next. When we look at the stocks above their 50 and 200-day moving averages, sorry for whipping around. Here's the visual I'm looking for. This is the percent of stocks above their 50 and their 200-day moving averages. This is not updated quite yet for today's close, but it's not going to change, I think, materially from Friday, when less than 2% of the S&P 500 is above their 50 days. So while the State Street chart looks interesting, and it's like, oh man, maybe this is a bottom, remember, we are still light years away from the mid-80s, which is where we were about 6 weeks ago. And we're even far, far away from the 50 and 200-day moving averages. So even though this feels like a short-term momentum boost, and you have this bullish divergence, and it feels like things are getting better, again, this could rally another 8 or 9 points and then do the next leg down. And years from now, that will be the most reasonable bear market phase ever. In the key to the moment, though, it feels like we're, that it's short-term bullish. So again, remember about the time frames when you're seeing some of those moves in stocks like State Street. Don't get caught up into thinking that we're at the end because of some of the rallies that we've seen. But look for opportunities, of course. Just to wrap up today's market summary, then I do want to get deeper into some sector and some stock themes. It's really the focus of the day here on Mondays. There were a couple of markets that were down when I'm looking at the global equity ETF universe. We look at frontier markets actually down the most, followed by Mexico, followed by India. The average market was up, and you can see the world ETF, URTH, was up 2.6%, so a little less than the overall S&P. Australia and China, the first two, looking at that entire list. Just looking at some of the industry groups that moved the most. So these are industry groups that had a pretty decent 4 to 5% plus gains today. Pharmaceuticals, number one. Utilities, we have the water group there. The software group, this is Apple's group. Media agencies, so quite a differentiation of sectors represented in those top 10. But what's interesting to me is a number of consumer staples, brewers, food products. These are not everything is better, let's ride this next bull wave to previous highs again. This is more of a we're going to make it through types of things, and what type of companies are going to help us get there. Something like medical supplies, for example. So some interesting moves in those groups. And again, I would remind you, as always, focus on the relative strength, because I think there's certainly some opportunities in some of these groups if you're looking at the relative stories that go along with them. Our next segment is called Sector Setups, and what we like to do with some regularity is look at the sector rotation picture, try to make sense of where these sectors are moving relative to one another. We're going to use the RRG methodology to start with, and as a reminder, if you're not familiar with this, we don't have enough time to really get down to the mechanics today, but if you look at Julius DeKempener's work, he runs Sector Spotlight, which is a great show on StockCharts TV. He's done some great videos explaining this methodology. I'd encourage you to dig into some of his work on our YouTube channel. You'll learn how this is a great way to visualize sectors rotating around the benchmark, which is in the middle. So a couple observations just looking at the weekly RRG. So this is a relatively longer term rotation that we're looking at. If you look, number one, step one that I tend to do is look at the upper right and see what's really getting it done. And if you look, the number one sector, when this has been the case for months now, has been the XLK, has been technology. So when I think about sector themes and I think about leadership, the number one thing that comes to mind recently, year to date, is certainly technology. This is a sector that has done well in bull market phases, right, leading up to the market high in February. It also has done well in the bear market phases. So in the last 6 weeks, it's actually held up on a relative basis very well. And something like that, where regardless of what it is, when it does well, when it outperforms in a bull market phase and outperforms in a bear market phase, that's really compelling to me. That doesn't make a ton of sense. I had Matt Maley from Miller Tabak on the show last week. If you go to the video of that on our YouTube channel, you'll hear his comments about tech as leadership in both bull and bear cycles. And I think there's really something there. The second thing that I would notice is the things that are really not getting it done. And energy has been a huge outlier. If you got rid of energy, the whole RRG would be sort of up in this upper quarter of the panel, but you can see that energy has been a huge laggard. And again, from any methodology looking at trend following, you'd be crazy to be considering something like energy. Now, again, when you're looking at something like Chevron, this reiterated their commitment to paying a good dividend. It's a decent dividend yield, and it's so beaten down that you're questioning whether or not it's going to go to zero or it's going to be able to recover in some way. I don't think if your runway's long enough, I don't think it would be, you'll regret owning really beaten down energy names, assuming they're going to recover at some point. But thinking more tactically, I think it's crazy. As a trend follower, using my main trend follower hat, I think it'd be really hard to justify something like that until you see some sort of improvement on the relative basis. The next thing I like to do is look at how the RRG is filled out. And looking in the lower left, you have industrials and you have financials. And again, based on this methodology, it's sort of an avoid on both of those. Financials are an interesting one. They're a really challenged sector, on the relative charts on those have looked weaker and weaker, especially given everything that's been going on. On the positive side, we're going to put the RRG in motion a little bit. You can see as you look at the last couple of weeks, look at how some of these really defensive groups, things like utilities, staples, real estate, sort of the big three in terms of defense, all now in the leading quadrant, all rotating northeast. That's all very positive. The last one that I would point out is healthcare, and arguably this is the second most impressive after technology in terms of rotating back out of the weakening quadrant back into the leading quadrant, emerging and heading northeast stronger than anything. It's sort of aimed in that the 45-degree range, which is pretty positive. So these are the sectors that are really emerging in a positive way. Let's look at some of the sector charts and just see what themes we can tease out of there. So first, as we mentioned, technology, right? So when I'm looking at the XLK, I'm looking at the trend from the market bottom in 2018, December, the market peak now from about 6 weeks ago, and now we've sold off and recovered. So, I use the Fibonacci retracements from the 2018 low to the 2020 high. You can see we actually broke below that lower end, that 61.8% retracement. We did eventually find support at the June lows from last year. This is a June 2019 low. Since then, we've now rotated back into this area. We're nearing pretty meaningful support around the 200-day moving average, which lines up with the 38.2% level. So that 85 level, I think, is going to be pretty key, and that's one of the key levels I'd be looking at with the XLK in terms of this bear market rally, sort of nearing that confluence of resistance, which could be a challenge. What's very interesting to me, though, is this chart at the bottom here. This is the relative strength on the XLK. And look at, since the market low in 2018, it's had its moments of underperformance over a couple weeks at a time, but the long-term relative trend has been remarkably positive. And something like that has been resilient in bull and bear cycles, I think merits consideration as more of a core position. You think of it, it's things like Apple, Microsoft, which are both offense. They're leading the way of developing our technology, but also more defense. They're big now, conservative blue chip types of names, and technology is integral to everything we're doing now more than ever. So the charts certainly seem to reflect that. A couple other sector charts I think are interesting to pay attention to. Utilities is an interesting one. Along with a lot of other sectors, you can see that the volatility is really exaggerated in the last 6 weeks relative to what we saw up until now. And I think most charts have increased their volatility exponentially, and the VIX being where it is sort of shows at a macro level how that's the case. If you look at the relative picture, though, with plenty of choppiness, overall the relative strength has been improving year to date, right? So I mean, we're up, let's say 12% relative to the S&P year to date, looking very quickly at the visual. But overall, it's come up dramatically from the low. So while a lot of sectors are sort of struggling, sort of just starting to bottom out, utilities really spiked and went vertical. And some of the groups within they're doing better than others. But as a sector, decent dividend yield and a nice relative story with the stocks, with the names starting to do a little better. Healthcare is the next one I wanted to look at. Again, it's rallied very quickly out of the lows. There are a lot of stocks within here that you consider some of the recovery stories, right? So biotechs and others that would, or maybe more of the coronavirus portfolio stocks that you would think would be at the forefront of these things, Regeneron and other biotech names come to mind, but also pharmaceuticals and others that are going to be more and more central to how we're thinking about our lives. But I like how the relative strength has continued to do well. Came off and sold off pretty dramatically going into the lows a week ago, but since then the relative story has improved as the price has rallied out of the lows. So I think that's a really actionable sector to be looking at, especially on a relative basis. The last is consumer staples, and again, I'm not as big of a fan of the relative story because you can see how volatile this has been. As opposed to technology, staples did really well at the beginning of the sell-off, but then started to capitulate lower along with everything else. So it's sort of when people realized it was a little longer of a sell-off, they got out of some of these staple names that seemed very, very promising at the beginning. So in terms of things to watch, I think staples are really key, and whether they're able to reclaim that high from a couple weeks ago, just above $57. So that's our sector setups for this week. And again, a lot of relative movements. The RRG is the best way I've learned to get a sense visually of what's happening relative to one another. We're going to take a quick commercial break, be back with shifting stocks. We'll see you in a minute. Hey, welcome back to our show today. I'm Dave Keller. I'm Chief Market Strategist here at StockCharts. Please keep your questions and your feedback coming. We've had so many great questions during this market sell-off and then quick market rally. And again, we're here to help you any way we can, empower you to make better decisions in your own investment. So just shoot a question to us anytime. The final bar at StockCharts.com is the best way to get your questions to us. We'd love to answer them during our mailbag segment, most likely tomorrow. We'll do a couple this week to try to address all the really good questions we have coming in, but please keep them coming. Love to help you out anyway. Our next segment is called Shifting Stocks, and what we love to do on a Monday is review some of the names that are really moving, right? What are the ones that are really in play? And for me, as you've probably guessed, if you follow the show, every weekend I like to look at the S&P 500 top to bottom by sector and just start to make notes of themes, patterns, all the things that are coming out. And it's a great companion if you have a top-down routine. If you're looking at the broad markets, you're looking at asset allocation, you're looking at sectors, that's all very, very important. But if you combine that with more of a bottom-up methodology using stock chart lists, looking at sectors by individual name, looking at industry groups, screening for stocks making new highs, new lows, you get sort of a very different approach. And a lot of times it's really interesting to do those two things separately and then marry them. And that's what I've learned to do over a number of years. So I want to share with you just some of the stocks that have emerged on my list of interesting patterns. So in this sort of environment, when you're in a bearish environment, I like to look for stocks that are really getting it done, stocks that are emerging, stocks that are performing well, stocks that are resilient, stocks that are actually managing to break to new highs at a time when nothing else seems to be able to manage that. And so in this case, we like to focus on some of the names really improving or excelling, and that's where we're going to go to the Scooter report. So again, the Scooter reports, it's the StockCharts technical rating. It's our proprietary method of trend following. And if you look on our chart school articles, we'll explain what the formula is and how we use it. But overall, this is a way to take a large list of names and sort them in trend following order. Here I'm looking at the Scooter reports for our large cap universe. If you've never seen this before, click on charts and tools. You'll see a link for Scooter reports. You can get right to this page. Then you can change the time frame in the upper left to look at different pieces. We're just going to look today overall where are things at, and I'm sorting it by the Scooter ranking. So it's a percentile ranking, and the top stock on the list is the #1 out of that entire large cap universe, and it's Citrix Systems, CTXS. You're going to notice if you look at this top 10, 15 list of names, you'll find what I would consider most of these are in what I would consider sort of the coronavirus playbook, right? It's the work from home names, Citrix and Norton, things like Zoom isn't on here, but those are similar types of patterns. You'll see healthcare, biotech like Regeneron, Vertex, and others. And then you'll see a mix of other things, right, that are arguably sort of all in this all of this group. So let's look through some of these charts and see how they actually play out. Citrix is a fascinating one, and what's so cool about this chart is it looks like how a lot of charts looked like about 2 months ago, right? And that's what's so interesting about it. So obviously there was a reason why this stock is doing well. So many people working remotely, looking for this type of software, and I know we use Zoom for a lot of things and are using it now more than ever just to manage our day-to-day functions of managing the company, and everyone sort of in that similar kind of boat of working remotely. And so CTXS is actually doing beautifully. It's making new 52-week highs at a time where almost nothing is. I think this is the only S&P stock doing it today. This is a company that is actually overbought with an RSI above 70, which is incredibly rare. If you look, all of that outperformance, though, has come in the last 4 weeks, right? This is all month to date that you've seen it outperform the S&P by 56%. So this is something that's gone from 102 up to 145 in about 4 weeks, which is a huge, significant move relative to what would be quote unquote normal for a name like this. So it's tempting to want to own a stock like this, and I certainly wouldn't disagree with the value of it. It's worth considering just because of the potential for an extended issue where people would need to use this company more than ever. The question is always where do you get into it? And this might be the type of name where some sort of pullback, an actionable pullback away from the overbought region might be a really good time to get in, a really good, more actionable time to build a position there. Next, we have Regeneron. I just want to look at a couple of the biotechs really quick. Again, these stocks almost look immune to what's happened. If you look at this chart for the last 6 months, you would not have guessed that the market has just gone through this tumultuous sell-off and then quick rally out of the lows. It looks sort of like long and strong up into the right type of chart. This is a stock that's held support around 420 a number of times. So on any pullback, I think a rising 50-day is a really good place to be looking for support. But overall, even here, it's well below the highs. The RSI is not unreasonable. It's actually a really decent entry point. Thinking about the longer-term trend, you sort of have an opportunity to buy on weakness with a stock like Regeneron, which I consider pretty compelling. While we're looking at biotech, we're going to look at Biogen, and again, this is one that's actually breaking to a new swing high. All these biotech stocks actually pulled back a little bit, so they're not overbought like Citrix. They're in a little more reasonable range, right? These are actually in healthy uptrend ranges, and I like that a lot of these have some really clear support levels. Biogen is even more, I think, straightforward than Regeneron, because if you look, there's great support right around 270, and this is the 200-day moving average as well. So an interesting level to look at there. You also have Vertex Pharmaceuticals, not to beat the dead horse of biotech, but again, I think these are really compelling names at a point where I think a longer position might be worth considering for sure. Then you have some semiconductors mixed in here. So AMD and NVIDIA, let's look at each of those. So again, all of these charts, the consistent theme with these stocks in the top 10 of our Scooter ratings is that they seem to be immune from the sell-off. Now, that's not true. I mean, the stock did sell off pretty reasonably, but it held an increasing 200-day moving average. How many stocks can actually say that? The RSI never got to the oversold region, so it's still more in the bullish range than the bearish range, which is pretty compelling, and on a relative basis has been a consistent outperformer. NVIDIA, same group, even more attractive in terms of its breakout, again, not nearing the overbought region yet, overall in a pretty decent shape. So all of these are at fairly compelling levels. And just to wrap up here, we're going to look at Netflix. Again, similar to some of the other charts that we saw here, none of these are really overextended based on our traditional momentum read. I would make maybe one final comment looking at these. I think the worry that I have looking at stocks like this is something like Netflix is now accelerating to a pretty significant resistance level. So 385 to 390 has been resistance going back here to last summer. It's again where we hit in February. This could be a huge cup and handle bottom, and a break above 395 would sort of be, a raging, to the moon sort of a signal, because that would be a cup and handle pattern when there are very few of them, if any, out there. But what concerns me is that we're entering what I would call a supply area. We're entering a level at which sellers have come in or where buyers have been exhausted. Even though we've been in an impressive point, the RSI is not in the extreme region. It's not getting overbought. It's petering out around 60. So if we would see a bit of a sell-off, if we hit resistance, the RSI doesn't get above 60, all of a sudden, this would start to feel more like a bear market range, and this would feel like more of the ABC or even a wave 3 going down. So I think Netflix, if I had one chart, maybe Netflix might be one of them, just to see, does this turn into a cup and handle breakout, which you would need to get a confirmed close above 395 to signal, or is this the next leg before a sell-off? I think this is one chart to really give you a good read on where investors' heads are going to be going forward. So that's our segment, Shifting Stocks. Again, today, what I like to do is just look at the Scooter reports. If you're not familiar with these, look to our Chart School articles, go to Charts and Tools to bring up this page, and you can look at some of the most attractive technical pictures based on a traditional trend following methodology. We are long at time and need to wrap up our show, so we go right to the 3 and 3. 3 charts, 3 minutes. Here we go. Chart number 1 is the S&P 500 for the last, I don't know, probably 5 or 6 weeks I'm looking at here. And I tweeted this on Friday because I jokingly said, look, this is a great trading system. Just sell Friday's close and buy back on Monday's close, or go short Friday, sell, cover on Monday. If you look, 4 of the last 5 weeks, that's been a pretty decent pattern. And the one time that didn't play out, which was here, the last week in February, you sold off pretty soon after and ended up doing okay anyways. Of course, that pattern broke. I guess tweeting it pretty much killed it. There's a lesson learned there. But overall, this is the second out of the last 6 weeks that we've actually managed to close higher. I think a lot of the challenging news we've seen for the coronavirus, where it's sort of set in, has been some of the news flow over the weekend, and that appears that pattern certainly has appeared to be broken. Again, I still see this as a bear market rally. I'm looking at breadth and still seeing it relatively muted, to be honest. Maybe tomorrow we'll try to dig a little more into that as a theme. Chart number 2 is looking at the ratio of financials versus technology. And I want to credit Ian McMillan, who's a fellow CMT. He spoke before me at the Chart Summit on Saturday. I had a blast watching his presentation. It's funny, I unfortunately don't get as much time to watch other people's presentations as much as I would like sometimes. I had a blast watching some of those, and Ian's was really, really good. And this is a ratio he looked at. He actually had it flipped. He was looking at, I think, tech over financials, but I'm illustrating it this way to show the underperformance in financials. So we're looking at how financials have been underperforming in this bear market phase, but that's actually not a new thing. That's just over here. This has been a long-term underperformance story that actually goes back to the 2007 high. Since that financial crisis, financials have really not been a relative winner at all. And this is a long-term challenge to the financial sector. It's a long-term question as to why you would ever want to own the financials over technology until you see this ratio materially start to turn higher. And that brings me to chart number 3 of our 3 and 3, which is the XLK. In our sector setup segment, we looked in particular about this. And again, something that is leadership in both bull and bear phases, I think you have to pay attention to it. If I owned a bunch of charts that looked like this on a relative basis through 2 different market regimes, I feel pretty good about the overall positioning that I've had. And again, in terms of a bellwether, I'm looking for something like this to see if and when it starts to fail. I think along with the Netflix chart, this chart of the XLK and facing resistance, 2 pretty key charts to watch. And ladies and gentlemen, that's a wrap for our show today. Thanks for joining us on the Final Bar every weekday after the close to debrief on the day's technical action. Please check out our previous shows on our YouTube channel. A lot of great content, a lot of good interviews for you to focus on. And also don't forget our special, The Pitch, looking at coronavirus ideas, coming up this Wednesday. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.